Hello trade pros and welcome to our YouTube channel. In today's video, I'm going to explain to you exactly how futures margin works and how it's calculated on futures positions for popular products like the S&P 500, the Dow, Nasdaq, and crude oil. I'll also show you why it's a good idea as a new trader to use less leverage, how it's calculated, how to calculate your profits, and much more. This video is jam-packed with information, and we're going to turn around and share a screen and walk you through this presentation. Before we begin though, please remember to hit that like button and subscribe to our channel and hit the notifications bell because we have great content coming out every single day. Let's dive in and talk about futures margin. So one of the first and most important things you need to consider when you're using margin is that in the market, some products are absolutely necessary to use margin and others aren't. So we're going to do a bit of a deep dive and focus primarily on futures. Remember this, margin is not how much money you are borrowing from a broker. It is how much money you need to put down in order to initiate and open this trade. There are two types of margins really at the end of the day, those that are set by the exchange and the ones that are set by the broker. And this focuses primarily on the futures market. So what's the difference? The futures exchange in the United States is the CME, the Chicago Mercantile Exchange. Their website is cmegroup.com, and you can find a lot of this information there for the product that you're interested in trading. Here's some CME exchange margins for some very popular futures products. One of those is the E-mini S&P 500. So these are the futures on the S&P 500 index. You can see that the margins change and are set ultimately by the Chicago Mercantile Exchange. At the moment, the maintenance margin is $11,500 US per single E-mini contract that trades and tracks the S&P 500 index. Now to get the latest margins, because when this video is recorded, may not be what the margin is at the moment, you could easily visit the cmegroup.com and do a margin check under the product. There's a specific tab that says margin that you could click on and get this updated information. For the purposes of this video, let's just assume it's going to be 11,500. The margins do change as markets get more volatile. The more movement there is, the more danger there is that a trader gets stuck in a position that they can't get out of and accumulates enormous losses and puts the broker at risk. During these times, the margins can increase and go up. And during the last crisis of COVID, there was a significant increase of margin to the point it was over $14,000 to hold just one ES mini contract. Now we're going to talk about the difference between CME exchange margins and those offered by popular brokers. Here is a margin sheet from AMP Futures, which is our preferred broker of choice, and we use personally at TRADEPRO Academy for all of our futures trading. So what you'll notice right off the bat is for the stock index on the ES contracts on the S&P 500, they have what's called a reduced margin of just $400 per day trade. So this means that while the CME requires a maintenance margin of $11,500, AMP will allow you to open a position with just $400 in your trading account. Now there's also the mini product, which requires significantly less, but also earns 1/10 of the size. On the positive side though is you're also losing less by utilizing the MES contract, which is the micro ES. So what is the discrepancy here and what is the difference between the margin on the exchange and the margin offered by the broker? We'll get into that in just a moment. But you can see to trade Nasdaq futures, the NQ symbol, a 17,000 margin is required by the exchange, by CME, and 1,000 intraday margin for day trades is required by AMP, the broker. To trade the Russell, it's 6,500 exchange and only 500 on the broker side. So what you can see right off the bat is that some brokers offer significantly reduced margins. And there is a catch. We'll talk about that in one moment. For the Dow, there's a 9,000 maintenance, 500 margin. And for energy products that are popular, like crude oil, there's a 5,100 maintenance overnight with 1,000 day trade margin. For micro crude oil, that is roughly 1/10 because it replicates the performance to a 1/10 factor. The maintenance there is $5.10 overnight and just $100 to initiate a day trade position. So when does margin switch from the day trade to the maintenance? This is a really common misconception because traders think that the maintenance margin is what's required to initiate the position. The thought process is, and this is wrong, that you need to put up the 11,500 to get long or short one S&P 500 futures contract and then maintain just 500 in your account to hold that position. That is actually incorrect. The reality is the difference between the maintenance margin and the day trading margin all varies on just 1 hour of time in every single day. So when we look at this product here for the ES, for example, the S&P 500 futures, we see that the futures actually trade from Sunday at 6 p.m. until Friday at 5 p.m. So futures are 23 hours a day, 5 days a week products, and it starts on Sunday at 6 p.m. Eastern time. So the markets actually open on the weekends. When do you have to post this larger margin? Well, one thing you'll notice is that they open at 6 p.m. Let me draw that a little bit cleaner. They open at 6 p.m., but they close at 5 p.m., meaning that the next futures day doesn't open till 6 p.m. again. This provides a 1 hour window in which the markets are closed for the futures products. And if there's any significant news or events that deviate the value or the price of this market, you're going to be stuck in that position until the hour passes and 6 p.m. hits again. And only then can you liquidate or get out of your trade. If it goes against you, it's going to cost you a lot of money. And if brokers don't push the margin to 11,000 and keep it at 500, you could get yourself in an over leveraged situation where you not only lose your own money, but now you owe the broker and you're in a negative debit position on your account balance. For this reason, what brokers do is from a $500 day trade margin, they'll raise it to 11,500 only if you want to hold that position between 5 to 6 p.m. So that's per contract. If you're long 3 contracts, let's say, and it's 4:55 p.m., and you don't sell those 3 contracts, you're going to go from needing $1,500 to keep that position open to suddenly at 5 p.m. to needing over $34,000, $34,500 to be correct, in order to stay in that position. If you don't have the margin, you'll get sold out, and most brokers will charge you a hefty fee for selling your position for you. So one thing you need to know is the only time this maintenance margin comes into force is if you plan to hold the trade through the closure window between 5 to 6 p.m. on weekdays or Friday from 5 p.m. until Sunday at 6 p.m. That's when the markets are closed, and that's when significant fluctuations of valuation of the S&P 500 could occur without your ability to transact and execute any positions to close out a potential loss. Now, obviously, if it goes your way, it's going to be a good thing, but at the end of the day, you don't want to expose your entire account plus put your broker at risk on something that you can't control the probability, and it's just, frankly, luck. So that's how you distinguish between initial margin, which is you could really call the exchange margin, and then the day trading margin you could start to call intraday margin, meaning that if you hold it intraday, you'll never need to pay more than $500 per ES contract. Remember this though, with margin comes leverage. Margin for the futures market is necessary. It is absolutely necessary to trade a contract, and you'll see that in a second. But the more that you margin and leverage your account, the greater risk you're going to be at blowing out with a small move against your position. So let me show you an example here with the S&P 500 contract. Again, this information is on the cmegroup.com. The contract unit for the S&P 500 is futures market, the ES symbol, is $50 times the S&P 500 index. And you can see that here at the bottom left. I've put a box around it. This means that every time you trade one ES futures contract, the notional value of the trade is $50 times the price of the index at the moment. Again, when I recorded this video, it was trading for $4,350, which would give you a notional trade value of $217,500 US. But your margin the amount of money that you need to put down in order to get into this position is only $400 US. Therefore, if you divide the notional value by the margin you're required to put down, you're trading 543 times of a position size than your money in your account. If you actually get in a situation where you're holding maintenance margin, saying, hey, I'm only going to trade one ES contract per $11,000 in my account, and I'm going to set a hard and fast rule for myself. Or if you go to a broker that doesn't give you a reduced margin and charges you the full extent of the CME. For example, Interactive Brokers is one of those brokers which charges a much higher rate. It's about half of what the CME is. So you'll be paying almost $4,800 to get long on the S&P contract. AMP Futures has significantly reduced margin, but for new traders, that could actually be a disadvantage. If you're looking at the maintenance margin and you divide the notional by it of 11,500 presently, you're getting a leverage factor of almost 19 times the capital in your trading account. So it's important to understand what comes with leverage and to never use up all of your purchasing power availability on any single trade. Not to come back from a losing trade, not to bet on a position that you heard good news about from your friend, not to YOLO your account. Never stretch your margin to its maximum. All right, remember this. For futures, you need margin to trade. For stocks and options, you do not. You can opt to pay the full notional value of the position in cash. And so if you're a new trader who is looking at futures but has a little bit of tendency to be on the gambling side, to over risk, to not have a trading strategy, avoid the temptation to go where there's high margin. You actually will need to have lower margin. And you could try to trade stocks and options to start until you get some experience before you expose your capital to this high margin availability. Because trust me, there are days where you'll say, these are my rules, I can only trade 2 contracts. But with the amount of capital I have and a low margin broker, now I could put 20 on at the max. So you go from 2 to 20 in a heartbeat, break all your rules and lose all your money. And at the end of the day, you're left with nothing, looking at this saying, I should have followed my trading plan. At the beginning, more margin is actually a bigger liability to the new trader. And remember this, you need less leverage when you're a new trader, and even less than that when you become experienced. The reason being is by the time you get the experience to be able to assess real-time information and take consistently profitable trades in your career, you're going to have earning potential. The more money that you make, the more contracts you'll be able to accumulate and the larger position sizes you could trade. So it's always better to scale your position with your experience and not with the amount of money that you have at the beginning. At the beginning, you want to trade smaller, you want to trade less, so you can give yourself a chance to ultimately learn more. That's what I had for you in today's video and in this presentation regarding margin. And there you have it, trade pros. I hope you've enjoyed this video. You now know everything you need to about futures margin, and you know when to use this as a tool and how to prevent some of the common pitfalls that gets new traders in trouble. If you like this video, hit the like button and subscribe to our channel, and be sure to hit the notifications bell to get alerts every time we have new content. We come out with new information every single day. Thank you so much for watching, and remember to head on over to our website and check out some of our futures trading education and development programs to help you take your trading to a new level. That's it for today. Have yourself a great day. We'll see you at the next video. And remember, always manage that risk and trade like a trade pro. Take care and goodbye.